You deposit your money in a bank, and you probably think it just sits there, safe, untouched, waiting for you. But that's not actually how banks work. In reality, your money becomes part of a much bigger system, a system that moves billions of dollars every single day. And here's the surprising part. Banks don't just store money. They earn money in multiple ways using a system that most people never fully understand. And no, this isn't a conspiracy. This is simply how modern banking works. In this video, I'm going to break down exactly how banks actually make money, step by step, in a way that finally makes sense. And by the end of this video, you'll never look at your bank account the same way again. Let's start with something simple. Imagine you deposit $100 into your bank account. You think your money is just sitting there. But in reality, banks operate using something called fractional reserve banking. This simply means banks keep a portion of deposits as reserves and lend the rest to borrowers. So when you deposit money, your bank may lend a portion of it to someone else. That borrower might use it to buy a car, start a business, or buy a house. And when they repay that loan, they repay it with interest. And that's where banks begin to earn money. Here's where it gets even more interesting. Banks don't just lend money. They earn through something called interest spread. For example, the bank may pay you 1% interest on your savings, but they may charge borrowers 5% interest on loans. That difference is called the spread. And when this happens across millions of customers, that small difference becomes massive. This is one of the primary ways banks generate revenue. Think of it like this. Banks act like financial intermediaries. They connect people who want to save money with people who want to borrow money. And in between, they earn a small margin. But this is only the beginning, because banks don't just make money from loans. They also earn from something else, something most people overlook completely. Banks also earn money through services and fees. Examples: account maintenance fees, ATM fees, overdraft fees, loan processing fees, credit card fees. Individually, these fees seem small, but across millions of customers, they become a major revenue stream. Ever seen a small fee and thought, it's just a few dollars? Multiply that by millions, and suddenly, it becomes a very big number. Banks also invest money. These investments are typically in relatively stable financial instruments like government bonds, corporate bonds, other financial assets. These investments generate returns, which adds another layer to how banks earn revenue. But here's where the domino effect becomes even more interesting. Because when banks lend, invest, and collect fees, something bigger begins to happen. Your deposit becomes a loan. That loan becomes a business. That business generates income. That income goes back into the bank. And the cycle continues. This is how modern banking supports economic growth. Understanding how banks make money changes how you see your finances. You begin to think differently about saving, borrowing, investing, because now you understand how the system works. Banks are not just places that store money. They are part of a system that moves the economy forward. And the more you understand this system, the smarter your financial decisions become. If you found this video valuable, subscribe for more personal finance storytelling. Because the more you understand money, the more control you gain over your future.